Let's also now shift focus towards the fundamental side of the picture. And if you have to look at it, pretty much we would say the stars are aligned for India in terms of the macro perspective. But how much of that is really translating to our markets? And of course, we do stack up compared to our peers. We do look like an interesting market to be investing in, but that has not stopped FIIs from really fleeing away, one would say. Now, there could be different reasons for that, and we are pretty much going to be dissecting what could perhaps be the reason for this. So is it just, those jitters ahead of an election or a budget, or are there bigger macro headwinds, not just in India, but globally that could impact even India? And let's discuss all of this with Feroze Azeez. He's the Deputy CEO at Anand Rathi Wealth. Good morning, Feroze. Thanks so much for speaking with us here at Money Control. I was just setting out the picture. We seem like we have a good fundamental story to be talking about, but the markets perhaps are not correlating at this point. Now, this could be, are our valuations overstretched? Are we getting ahead of ourselves? What really would be, if you had to point out could be the reasons why we're seeing such a big of FII outflow, at least in the past few days?
Hi, Stacey. Good morning. So firstly, like you said, there's so many things which you said. Let me try and dissect each of them. When it comes to correlation, expecting the markets to be correlated to the equity or to the macroeconomics in the short term may not be a fair assumption. If you look at it the long term, does the capital market correlate the economy? It certainly does. Let me give you some data to prove this hypothesis. If you look at the years 2001 to 2012, the GDP growth, the nominal GDP growth was close to about 13.6. Nifty growth was 14.9. The subsequent 11 years, 12 to 23, the nominal GDP grew by 10.9. Nifty grew by 11.4. If you look at this 22-year pocket in total, 12.3 was the nominal GDP growth and 13.1 is the Nifty growth. When you see all these three data points in isolation, two of them mutually exclusive data points of 11 years each, you would see that there's just about a 50 bips difference between the nominal GDP and the actual Nifty return. So point is, they are correlated in the long term. Now coming to the short term, I think we have not gone far ahead from where we were. From a valuation standpoint, I can't call it to be a very expensive zone. That's point two. Why do I say so? Is because if you look at the Nifty earnings, we started the year with 945 rupees of earnings estimate. That translated into something which we have now upgraded it to 965. So if on 820 rupees base, which is the last year's earning, 819 to be precise, you are growing to 960. That's a great growth. That's about 17-18% growth. So we have, if anyone sees the earnings of the last 4 years, on a sheet of paper from 530 to 770 to 820 to 965 and next year 1100, he or she would concur that markets have not gone overvalued because earnings have caught up with the prices.
Earnings have caught up, you're saying, but can we expect more correction in this current market? We are already looking at levels. We've come down to almost 21,000 from seeing those highs of, more than that. So are we expecting, at least in the coming weeks, to see some bit more of correction in the markets?
Yes, Stacey, I think the markets, there are four things which or three things which are important to see, is when the base is larger. Now we are at 22,000. 1,000 points is different than when you are at 17,000 and 1,000 points. 1,000 points today is less than 5%. 1,000 points on a base of 1,500 is 7%. So the numbers are going to be larger. Like when you see Sensex, it falls significantly more in terms of an absolute number because of a larger base. That psychological recalibration every investor has to do when market levels change. Otherwise, you get perturbed too much by looking at points. So that's one. Point two, markets have this tendency to fall every single year. An investor with a 10-year investment horizon, or even 5 or even 3, will at least see 15% corrections, if not more, at least 4 times in his 3-year period. If that's the nature of the beast, which is equity, that's why it gives you 3 times more than an FD return. If you mentally prepare yourself, in 3 years, you are going to see 4 times a 15% correction from the portfolio value you saw yesterday. Then you will not be so perturbed and you will not take emotional decisions. You will be more prudent in decision making. Third, the pace at which market falls is dramatically different than the pace at which market goes up. the number of 1% fall days are significantly greater than 1% up moves on a specific day. But the gravity of the market is always on the highest side. Like the Earth's gravity is down, a market's gravity is up. If an investor reminds himself that the gravity is up, betting against the gravity is not a great idea.
Right, so betting against the gravity, clearly not a strategy one should be using. But let's also address a couple of stocks which are on focus and a couple of earnings that have come in, and then get back to Feroze to get his perspective on them. I'm talking about Axis Bank, because that clearly was, of course, in your top losers list. Now this because it has recorded only about a 3.7% year-on-year profit at coming in at about 6,071 odd crores, whereas the net interest income for the quarter just grew by about 9.4% at 12,532 odd crores. Net interest margin coming in just about 4.01% for the quarter. Asset quality front, one would say it has fallen. Net NPAs have fallen by 15 basis points. So you're looking at some bit of improvement in the asset quality, but overall bank numbers now, those are pretty much on. They've not really lived up to the expectation, we would say. And when we started this year out, we did think that, the banks are going to be the outperformers. But so far, if you have to look at it, perhaps maybe not living up to those expectations, one would say, and which is why you're seeing this huge outflows as well. But let me get Feroze's perspective and ask him about the banking sector as a whole. We've seen pretty much most of the private banks at least come out with their earnings so far. And most of them have missed estimates, one would say, although there are a couple of brokerages that continue to remain or have an outweight or buy call on these names, be it like Axis or ICICI Bank a day before that came out with little bit, some bit of relief in terms of numbers. But overall in the banking pack, how would you really be, if you have to give a pecking order for them, especially for these private banks now, what should one be using, what should be the strategy and what should one be looking out for when you're, trying to add these to your portfolio?
Yes, Stacey, if you look at larger banks, I would say that what's so unique about larger banks from a demand supply standpoint, and of course earnings everyone knows, they've deciphered. I think one thing which stands out in my mind when it comes to the banking sector is Nifty has about 35% of weight in the BFSI. The topmost sector is that, and the second one is IT. If you look at 35% of Nifty, and these private sector banks which you mentioned are top 10 weights of Nifty. What happens when it comes to Nifty is that a lot of this free float is gobbled up by passive funds. And that's what is going to be the trend for the next 3-4 years. EPFO has a passive fund strategy, and EPFO has a few lakh more crores to deploy in the next couple of years. So what's going to happen is there is going to be buoyancy on these stocks. So if you're going to be looking at the banking sector to be the anchor of your portfolio, it's a great strategy. I don't think it will give you significant return, but it will reduce your risk over the next few years because it is going to be a liquidity-driven market. If the government continues, there's a lot of money outside the country waiting to come in. And if it so does, the first thing which happens is the top 5 stocks of Nifty get cornered for good. A passive fund does not give back the supply which it has taken away from the capital markets. So that's the point I'm trying to make. So these can be a very good anchor strategy for the next 2 years if you believe in a cash flow coming into India or liquidity coming into India, which I think is a larger probability. So that's how I would see this. Second, I personally think that in the banking space, the business models are reasonably divergent. They look very optically identical, but if you go down to the brass tacks, there are very, very different business models which are very well diversified. So I think combining a certain bank basket, which on a day-to-day basis are correlated, but on a 2-year, 3-year basis, if you look at their betas with each other, they're significantly low.
Right. Another sector that I would want your view on is the auto pack. Now, today, of course, the auto index is pretty much down and about, and we saw a couple of those names make it to the laggards, at least for early trade. But we do have earnings coming up for at least two-wheeler earnings, where we're seeing Bajaj Auto as well as TVS come out with its numbers just overnight. We did hear from Hero MotoCorp as well, and they've gone on to launch a couple of more premium products. So what really is the place especially for two-wheelers? Because up until now, we always looked at them to be, whether it was the rural recovery that would really guide the numbers for the stock. But now we are going to the extreme end and we're looking at premiumization and how these companies are now focusing there, and that's where they're seeing the sales numbers as well. So how should one really be looking at auto stocks specifically, and what would be your play for them?
My play for them would definitely be the rural demand still. Of course, some structural changes like these and market creations take their own sweet time. I think that you should still look at auto from a rural demand pickup hypothesis, and I think that is going to happen because the kind of back-ended expenditure by the government, which has happened in this financial year, is enormous. So when you look at 7 months number, which I correctly remember, is that we had only penetrated 44% into the fiscal deficit target. Fiscal deficit generally by 7 months is 73% penetrated. That's the long-term average. So there is a lot of back-end spending in this financial year, and that will transpire in a few months into the rural demand. So I would be far more bullish in their already established segment, not the premium segment, from a short-term standpoint. Of course, from a long-term standpoint, the kind of margins in the premium segment are significantly more, and that could definitely play out. But if you're a short-term player, I would still look at this hypothesis, and I think this hypothesis has a large merit to put some money on the table.
Interesting, because most of the people that we've been talking to have been talking about, consumption and discretionary consumption, and especially with premiumization taking place at such a large extent, they would see, rather want more from these at least two-wheeler companies. But yeah, of course, rural play will and cannot be taken away, and that is pretty much what will also be guiding these two-wheelers. Well, thanks so much, Feroze Azeez, there from Anand Rathi Wealth, for giving us his perspective on the sectors that we need to be looking out for, and also the stocks which are pretty much doing the rounds today, doing a buzz in trade. Thanks so much, Feroze, for your time.